Peter wasn't he? Didn't he? He was. We missed him last week.
Yeah,
Didn't he?
Peter, we missed you on Wednesday, was it?
Yeah, everyone was worried, and because my first reaction, Peter, is like raised by my mother.
I'm alive. It's okay, guys.
Oh my God! Oh my
Good,
God!
all right.
It's not
Yeah,
like Peter.
that was my mistake. Sorry. I
was
got
calling the
lost
hospitals in Germany and everything, but thank
No,
God
sir.
you're
Peter,
good.
glad to have you here. Thanks for sharing your knowledge with our community. I'm going to pass you over to Dale.
Yeah, thanks, Blake. Thanks very much, Steve, and also hi to Dale.
Hello, Peter.
I'm sorry about that. I got lost in my chart. Sorry, and
okay.
when I do that, sometimes there's a time warp, and I don't know where I am.
Yeah, but it's a good sign. People worried because they wouldn't know, the wave structure of Bitcoin without you.
Oh, Bitcoin,
so,
yeah.
You think they care because they love you, but they just couldn't live without. They couldn't live without your work. So, anyway,
well, that's a sort of love, isn't it? I mean,
it's love and greed and all of that good stuff. So,
yeah,
share your screen, buddy. There's a lot going on, and great to have you on here. Someone also posted earlier. Okay, we could start there, but some guy, David Murrin, just did an interview on Palisades that we've been on, that there'll be a big washout in gold still. So
that's interesting.
Yeah, so we're getting I'm seeing more and more of that. Gold is not gonna.
Do you want to start with gold then, or what?
Yeah, let's start with the metals here.
Okay.
Although you know what? Let's start where you wanted to start. So we broke down under. Everyone was looking at that little 4100, that little rectangle that was in this week, and it broke down. You showed this can be a break to buy here. We're not going to take out 3800 right away.
No, I don't think so. I mean, I'm starting with this daily chart because for those guys tuning in today that aren't familiar with what we've looked at in our forecast before, one of the big things which I'm typing up our mid-year report at the moment, and so I'm sort of a bit focused on some larger perspectives as well. But
just for people who may not have been following your work, you put out a special report at the end of last year. Calling the top, and then I had you on around A on the first decline, and I was saying, well, couldn't that just be it, and one ABC, and we go to new highs, and you said, well, we could rally, but I think this could be a failing rally, which it was, and then down here at this 3800 level for the last several weeks, you're looking for about 4460.
Yeah, I think the take-home message that I'd like to convey really is that, first of all, when we got to the pandemic low, the secular bull uptrend was still intact. This was an intermediate fourth wave correction. So we've got targets up to about just shy of 6,000 for the S&P. For later, yeah. But the biggest impact really is that the post-pandemic advance, we're used to thinking in Elliott wave terms of 5 waves as depicting trend. But there's an exception to that, and there's only one exception where a 5-wave pattern begins with a zigzag. And we've determined that this is a zigzag because, if you take a 61.8 extension, which is a normal ratio to depict a zigzag, if you extend wave A like this by 61.8, you're getting within the price parameters of that top in January. And this confirms the zigzag pattern. Now, the only pattern that you can really construct together as a zigzag when you've got an uptrend is the ending type diagonal, which looks like this. So here's the zigzag, and it becomes wave 1 of the ending diagonal. But by default, if we're looking at this contracting type diagonal, by default, you're going to have a deep correction downwards, and that's what we said in December's annual report.
Yeah,
we said, well, look, we
raised it a little bit, didn't you? Wasn't it more like 26 or 2,500 for a final
2640 is the 76% retracement. Normally I default to that because, you see it so often. It depends on the amount of time consumed. What's important about the downside target is that it can be either 61.8 or 76% generally, but you've got to get the angles, your angles correct. If you get a sharp, much steeper drop than this, what we've had so far, you mostly end up with 76%. But if you're consuming more time, then you'll probably end up at the 61.8 area, which is roughly 29.32 on this cash basis. And I think that's probably where we're going. Down here, this is a 61.8 retracement, about 29.33.
Towards the election.
Yeah, yeah.
Because I've heard for some guys that don't think the Fed changes course until November.
Yeah, I don't think they can really, can they? I mean, they're all behind the curve. I mean, it's not as if these guys are really up on it. I mean, to be honest, I'm a big detractor of the central banks because they're brainwashed into sort of Excel spreadsheets and linear extrapolation, and they're far behind the curve. If they had a bit of foresight, they would have started to jack up interest rates in September last year after the northern hemisphere went on came back from its summer holidays, because that's when CPI really started to take off. But they missed the signals. And also, if you look at a lot of long-term cycles in interest rates, you can see that actually the 35-year cycle, which topped out last in 1981, was bottoming this during the last decade.
Right.
Into the financial crisis. Then it stretched again because we had central bank intervention. So you had a sort of a synthetic support mechanism going in, and that sort of stretched the cycle out. But I mean, the more you stretch something like that, the more you're going to get a whiplash in the opposite direction afterwards. And that's why you've got this effect after COVID with CPI and inflation going berserk to the upside, because and it can't be I mean, anybody that's really a historian looking back at those sort of scenarios in the past has to realize that once you let the genie out the bottle, it's off and away. And that's what happened, when Bretton Woods was disbanded in the 1971, and the whole gold standard was dismantled. So you let basically the gold standard drop away. You've created a sort of a fiat monetary system, and that sends inflation up. And the next minute, you have central banks chasing the tail, and this is an exact replica of what we had in the 70s. I mean, why these guys haven't already signaled that what's going on, I can't say for sure, but I think it's just like a bit of a drug, Peter, of cheap money, isn't it? I mean, everybody's drugged up Peter, with the.
Would you say that Europe's even been slower, even more behind the curve? All right, so tell me why, fundamentally, besides your wave structure, you're looking for a dollar crisis.
Well, I think the only way that the US can basically get itself off its cheap money scenario is by devaluing the dollar, because
so it's a policy option.
I think it's probably not a policy option. It's just, I think they're going to be forced into a corner at some point. Okay. And I think also, don't forget that this whole scenario with Ukraine and Russia is a bit of a sideshow, really, to what's going on behind the scenes. What's in the last few years, what's been going on behind the scenes is that China and Russia have been commoditizing their currencies in a big way through the purchasing of central bank purchasing of gold, precious metals, well, mainly gold, and trying to basically break the US's dominance as a dollar reserve. Now, it's inevitable that the dollar will not be able to hold on to its dollar reserve status to the same extent that it is. It won't be a crunch overnight. It's going to take several years, but you've got a way of reducing inflation through basically declining the value of the dollar. Plus, you've got this scenario where these other sort of Asian basket countries, led by China and the Eurasian banking system, is trying to wean itself away from dollars. That's why they're putting so much exertion and pressure on paying in local denomination currencies. I mean, the Russians are asking the Europeans to pay for their natural gas in rubles, and they said, "Well, cut you off if you don't." And so far, that seems to be working.
Yeah, so we kind of went through the Rubicon when we weaponized the banking and SWIFT system against Russia, so that if there was any trust left about feeling comfortable with your assets in that system not being frozen, that was kind of a signal that depending upon the administration, that your money isn't safe, your assets aren't safe.
No, and I think that if you're living in the US and you're domestic run, I mean, okay, you're going to be seeing the dollar. The dollar will devalue, but you won't feel it. Only the only way you'll feel it is through inflation, which is what you're seeing now.
Right.
The only thing missing really is a major dollar decline. But talking about the dollar, I think that we're on the cusp of seeing a change in direction. Probably already have. When we saw this month the dollar start to decline from, say, 105, I think we've had 5 waves down from that peak. And we're going through a bit of a correction. I'm updating this chart tonight for our report. You can see that basis the CPI number you just had, that we've stretched up a bit higher. I had a target earlier this week at 103.28. We've pushed it up a little bit
1%.
to the 61.8 extension level. We had 38% extension originally, being a bit conservative with that. But if we can extend this like this by 61.8, that's probably done that rally already. I'll be selling dollars here and seeing it to come down. But overall, the problem we've got with the central banks is they're doing too little too late, and they're trying to catch up. A lot of the short end of the curve, like the 2-year treasury yields, they've already priced in most of the rate increases that the Fed can do this year. But a lot of the analysts in the investment banks at the moment are more concerned with the fact that we're facing a recession. Well, I mean that technically means that you've got to have 2 GDP quarters, in negative. I don't think we'll get that. We'll probably get 1. But so technically there won't be a recession. But I still believe that when we take a look at our forecast for the S&P, we're still going to see this next downswing develop. And of course, at the beginning of the year, towards the end of last year, when Deutsche Bank did their survey of all the investment banks and what they expected the S&P, so over 70% expected the S&P to be 5% or higher this year, and 30% said it was going to be lower, and about 20% of those said it would only be 5 to 10% lower. And there was only 1% said it would be 20% lower. Well, we're down 20% already. So only 1% of the analysts in that poll actually had a forecast of 20% drop this year. Now, don't forget the NASDAQ's down 30% and the FANG's index is down 40%.
Yes.
Wow. I mean, that's incredible numbers. And I think we've still got more to go. Now,
it looks like this next wave, if we get it up there towards 44.5, is going to be much more directional than the first part from the January high to 3,800. There were so many zigzags, and I was trading it. It was very difficult to hold positions, except for that one rally back towards 45, 50, 4,600 before the dump. That was pretty impulsive. But a lot of the other stuff was hard. You just have to really just be bearish and not watch it for 2 months.
Yeah, well, I mean, we're pretty much when we're doing our type of analysis here, we're quite reliant on using fib price ratios, really, because generally speaking, our background thoughts are that most of the markets will deliver and unfold into specific fib price ratios, and most of the time they do. Sometimes they don't. And that gives a bit of open questions, and you've got to then sort of do some correlation ratios with maybe some related indices that have a different pattern, and choose one which is like a new benchmark or archetype at the time. I mean, when I remember this rally that you're referring to up here, I mean, that's a pretty good number, isn't it? When you get to 61.8 extension like that, and you go into reversal. So that was pretty well telegraphed during that time in late February, early March, that recovery.
And to get your scenario, Peter, we shouldn't take that high out, should we?
Which one? The
one
secondary
we're
one.
talking, yeah, we should not take that high out on this recovery.
Well, this is classified as an X wave,
Yeah.
and X waves can take that high up if they
can,
wanted
huh?
to. Yeah,
Oh,
because
wow.
because an X wave is a correction to the preceding zigzag, which starts from
Okay.
48. So what it can't do is break 48, but
Okay.
it could break 46. I don't think it's going to do that anymore because look, here we've got what I think is a 5-wave pattern up here. I think if you look at the NASDAQ, this where I'm pointing to right now, that was a slightly higher high than the one on the left. So I think we did get 5 waves up. That was also the case in the Russell 2000, the small cap index. So we've got a truncation here on the S&P. I think probably we're getting close to finishing this already with the CPI news coming out.
Yeah.
And then we should get an extension ratio here. If we multiply that by 38 or 61.8, we're going to get into this little band of range here, and that should be, that should be enough to finish it really. So I don't think we'll go any higher than that, and then we can start sort of to plot the next decline. So, but overall, this is pretty neat stuff. I don't think there's going to be too much to worry about. The interesting thing that we had, of course, at the end of May, was that everybody was supremely bearish at the time. You probably have access to the CNN fear and greed indicator on their website, which was
it was profuse.
Very, very. And Bank of America Merrill Lynch, they sometimes post on the web some of their global fund manager survey results, and you could see that bearish extremes were very evident there. In fact, some cases, particularly in the NASDAQ, there was such a bearish extreme. They hadn't seen that since financial crisis. It was even more bearish than it was at the pandemic low. So we had a pretty good indication that there's going to be a counter trend rally. Since then, 1 or 2 surveys have come out from other sources, and they've said, that pundits have said that the rally that's currently unfolding to the upside is purely a counter trend rally, and yet they've said that there was an 80% advanced decline during this rally here. 80% of the equities were in advance rather than declining, and that normally is associated with a new bull market. So there's some pundits out there saying, "Hey, we're in a new bull market now." So there's a lot of conjecture going on. I think that as time wears on, I would have a fairly strong conviction that we'll get up to these sort of numbers, and then we're going to start dropping again. And by that time, this whole CPI thing might wear off a little bit, and we might revert to a little bit more bullish scenario going through the rest of this month into July, and then it's down to really basic economics, whether or not GDP is contracted by that time, and whether people start fearing that
they say they haven't priced in earnings downgrades yet. So, that
takes time, doesn't it? I mean, that's a bit of a lagging sort of indicator. So what happens with the markets always, and it's very typical with interest rates at the moment, is that things lag. The data will lag. Certainly data does lag. I mean, it's like the ECB and the Federal Reserve and all the other central banks are really lagging far behind the price action. That's why we have to be very careful not to get carried away with expecting bonds to continue sort of declining rapidly, because a lot of the decline is already priced in, you see, and even though the central banks are hiking rates, there's a dislocation between what the forward months are doing and what the central bank's doing in the spot sort of situation.
Speaking of lagging, I've noticed that on this last rally before this decline in gold and silver, that the miners were lagging the move in gold. I own miners. Is there a different count in the miners compared to the gold and the silver?
Well, there is to some extent, because you're looking at bullion underlying as a commodity, and then of course if you look at the gold miners, it's an equity related entity really.
Because like Newmont's challenging the low it made when gold was 1780 that day, and Newmont's back to that low.
Yeah, well, I mean, the thing with Newmont mining is that during the last several months, actually, it outperformed relative, say, to the GDX that you see on the screen here now. It pushed up and broke beyond these highs that go back to sort of August 20. Remember August 20 as a date? That was when gold sort of initially went up to 2070 back in August, and everybody got very excited that gold was going exponential, and then it sort of ended up in a two-year correction down. So, but that was a very important date. Newmont Mining. Let's have a look. I've got that here.
So you think GDX could make one more new low while gold holds 1780?
Yes, I don't think gold will go back below 1790 on spot.
Okay.
No, and here's Newmont Mining. You can see, look, it
so
broke.
You'd be buying it right here because it's right there, I think.
Yeah,
I prefer. Hasn't opened yet.
I prefer Agnica Eagle because that one hasn't really done so much since moving up. So I'm actually looking at those which have been a little bit lagging. Let me just see if I can find it here.
Do you prefer silver miners over gold miners?
Well, I prefer silver over gold to outperform because of the gold-silver ratio. But when I went through some of the silver miners in order to sort of expecting them to be bottoming out as much, I couldn't find one that I really fancied buying at the moment. So I'm going to wait on that issue. I think it's right to buy the gold miners. I mean, I don't expect Agnica Eagle to break below 49.56 and certainly not below 45.41 because this, decline from the August high, the August 20 high. You've got a very eloquent zigzag down there, and you've got equality in the two swings, which is atypical of measuring another form of measuring a zigzag. And you've also got a nice three-wave decline since 67. So I think that that's pretty safe if you're buying it on an unleveraged basis, which most people would do anyway. You're pretty in safe hands. This uptrend, will take off. And I think gold bullion, although you've seen it sort of pop down in the CPI news, look at the way it's behaving in the last few minutes. It's running up again. And I'm a great believer that silver and gold have bottomed already, and that and I think that Steve mentioned earlier that the bigger picture looks bullish on gold. Just before we started talking together.
He said lower now, so that's what I mean. Even the gold bulls are capitulating now that technically they think it looks bad with this action that they're seeing down here. I've been talking about 1810 as being a possibility, and 2210 in silver. I don't know what we got to here. What's the low that we have there so far?
Well, that after the CPI news on bullion spot, at least it got to 1825 here.
Okay.
And it's back up to 1842. So I'm, once
see
we're done, I'm going to be
doing interviews.
And once we're done, I'm going to be buying this. As soon as
I know. So anyway, silver reverse too. Give me a report.
Yeah. I mean,
and euro reverse too.
Silver. Look, we've got down to here. I mean, these are really great levels. I mean, silver was perfect because look, back in May last month, we had a target of anywhere between 2064.53. We got to 44. We've had a nice reversal. The diagonal is crystal clear, really. This diagonal pattern, which is where you see of the expanding fact that goes back to the August 20 high. I mean, of course, there's nothing worse than actually seeing a perfect pattern, because if you start believing in it too much, you can always have that ability to be stopped out. But to be honest, I would assign a very high probability that silver bottomed at 2044. Should be buying on these dips, really. And I think looking at the gold-silver ratio, and I've got one here, which is quite phenomenal, really. This shows that when we got to the pandemic point in March 2020, this is just coming into view because it's actually taken the spot foreign exchange and working it all out. But it'll come alive as the data comes in. There it goes. But you can see it at the pandemic high at 126. That's 126 ounces of silver to buy 1 ounce of gold. Now I since learned that during one of the Greek philosophers had mentioned in a text. I
Oh,
read
Steve
this.
Volge
Yeah, exactly.
or Stelios Kantos.
Yes,
They're
exactly.
philosophers.
Yeah. And the gold silver ratio was what, 12-1, right?
Yeah.
And that was how it was historic. 126.
Steve remembers.
126. Yeah, he should. 126 to 1. Look,
Yeah.
I mean, come on. And
Yeah.
anyway, we've seen 5 waves down, a nice expanding flat pattern into 88. It's hit all the right numbers, the 23% extension of this. It's a 5-wave upswing. This upswing, by the way, well, the expanding flat began, hey presto, from August 20. So whilst we've had an expanding flat pattern in silver decline, you've had an expanding flat in the gold silver ratio. So this widened out during the time, it hit 88.30. Now this is going down in a big way. So if you're really a gold bug and you're out there and you think, yeah, I want to get long of gold bullion.
You said that like Dennis Gartman says. He says
Yeah, what does
long
he say?
of. He goes, I'm short of gold, I'm long of gold. And it's the first time I heard you use it. So it must be a European term. Long of gold. Go ahead.
Long of.
We don't use of.
What do you say?
Just long gold.
Oh, okay.
How are you of gold?
Oh, okay. Well, yeah,
All
we
right,
use the
anyways.
possession. We use the possession.
Look,
because,
I'm a crabby old man today.
No, it's good. No, it's good.
All
I
right,
mean, you also say horseback riding, don't you, in American?
Yeah.
I mean, where else are you going to ride a horse?
Yeah.
What do you need the word back for? Anyway, well, the Europeans have put of in front, so it's a sort of possession pronoun. So I think, anyway, right. I mean, there you go. But I mean, overall, if you want to be a gold bug and you want to buy gold, it's actually better to buy silver because of the gold silver ratio. But we had a look at a platinum gold ratio recently and a platinum silver ratio. And it looks like platinum will outperform silver. And just this week, my colleagues and I, we've been discussing what palladium looks like, part of the palladium group metals, the PGMs. Right. And we figured it out that palladium is going to outperform platinum.
Wow.
Into the inflation pot. So gold.
Russia, a major producer, is that the fundamental behind it?
Well, very likely. So gold's in 4th place behind silver, silver behind platinum, platinum behind palladium. So,
wow.
That's
catalytic converters.
Yeah, well, that's right. The European Union yesterday passed legislation that all combustion engine vehicles must be phased out by 2035. That's called a bit of a raucous.
Yeah.
So if you're buying a very expensive car at the moment with a combustion engine,
you're gonna have to scrap it.
It's going to be scrap in basically 13 years time. You've got to, it's going to be illegal to drive. Okay, car's lifespan is probably about these days, isn't it? But
all right, how about just one quick look at the long end of the curve, maybe the bond market? Are we finally getting making new lows in bonds, new highs in the 30-year yield without the 10-year doing the same?
Well, we should be. There's a very distinct picture between the 10-year and the 30-year.
Yeah.
And the distinction only comes because if this is the 10-year yield we're looking at the moment from the pandemic low. The distinction really comes here around this point, which is I think April 20 and then this August 2020 low. Because this low, this one here, the second one is lower than that one, but in the 30-year it's not, which makes it different. This is describing a 5-wave diagonal, a leading diagonal. So the composition waves, the impulse waves are composed of 5 price swings. For the 30-year, it's a bit different. You've actually got
a new high in yield today, probably.
Yeah, you've got, well, no, not quite.
It didn't do it, huh? On a strong number? That's interesting.
It didn't make a high. But here you've got a zigzag because look, you've got these two. This one is slightly higher. So basically, doesn't matter too much, but it's an interesting point to assess. This is a zigzag, A, B, 1, 2, 3, 4, 5 up. Actually, it's a diagonal. It looks more like this. So so in actual fact, when you've got a
Peaking.
diagonal,
Yeah.
you're pretty much knocking on the door to a top. So we shouldn't be really making too much upside progress anymore. I think we've probably topped out already.
Well, you're the tops, Peter. How do people follow you and you know, go to your website and sign up?
Yeah, thanks a lot. Yeah, I mean, if you're interested in subscribing to our stuff, we welcome the opportunity to greet new subscribers. Maybe I can just
Go ahead.
show you where to go. I think.
Yep.
Yeah, this is our website, wavetrack.com, and down here somewhere, yeah, the subscriptions. And if you click on subscription, this is our most popular product for an individual investor. It's our Elliott Wave Compass report. It's $39 a month, and you'll get 2 reports a week, and you can download them using a PDF on our website. But you've also got an interactive login, and all of those latest charts for the reports are posted in there. So you get best of both worlds, and yeah, we'd be happy to see everybody if you want to subscribe, and I think you'll find it some pretty good value.
I concur. And Peter, I want to thank you for sharing all that hard work. I know you're like a mad scientist when you get lost in your charts. It's a I don't know, you astral project at the same time, and it's okay. And just goes to show that, you know, people do care about you because of the person you are and your great work. And so really thank you very much for having a giving spirit for all these years, and just sharing your wave counts that take a long time to come up with for free with our community. Thank you, Peter.
Well, Dale, thanks. It's very humbling you to say that, and I know things are pretty tough out there for everybody trading. You know, I'm committed to making sure you get the very, very best. I won't settle for 1% less than 100. And yeah, and I appreciate you also giving me the opportunity to share my thoughts today and with everybody. And if you're listening in, thumbs up to Dale. You're doing a great job, and your immense knowledge, Dale. I really appreciate it. You always ask the right questions at the right time, and I really appreciate it.
Okay, well, you crystallize things for people, so you know we better get out of here. People, they'll post, get a room. That's what people do. So yeah, Peter and I have a bromance. He's my trading warrior brother. Thank you, Peter, very much. And everyone, you could join the team in 9 minutes for the morning edge, and hope you had a good week. We laid it out on the court for you. And remember, most of all, don't just count your pips, count your blessings. And thanks again, Peter.
Great, Dale. Thanks. Thanks to you too.
All right.
And thanks to the whole team there at ForexAnalytix. Thanks, guys, for the opportunity today, and thanks to everybody for listening in.
All right. Adios, Peter.
Adios.
Adios,
Thanks.
F.A.C.E. See you guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.